Imagine for a second, you wake up one day, check the news, and there's this announcement. The government requires citizens to turn over a specific asset you own.
Yeah, like something you've been holding on to, maybe thinking it's safe, outside the system.
Exactly. Maybe something like gold or who knows what today. And you have to hand it over by a certain date, and you get paid whatever the government decides it's worth at that moment.
Sounds pretty wild, right? Almost like something out of a movie.
It does. But something very much like that did happen in the U.S. back in 1933, Executive Order 6102. People often just call it the gold confiscation.
It's a piece of history that honestly still gets talked about a lot and argued about. Was it really a confiscation, like all gold? What was going on that led to such a, extreme step?
And the big one, the question I think everyone listening wonders about, could anything like that happen again to Americans? I mean, today.
That's the million-dollar question, isn't it? Or maybe the $35 an ounce question, adjusted for inflation.
Ah, right. So those are the key things we want to unpack in this deep dive. We've got historical records, the order itself, the laws around it.
Yeah, and economic analyses looking at gold. What role it played back then versus now, plus some public discussion, how people remember it or maybe misremember it.
Our goal here is really to get past the simple sound bites. We want to look at what EO 6102 actually did, why it happened, what the fallout was.
And then try to figure out what lessons, if any, it holds for us now, thinking about our own assets and, government power.
Okay, so let's dive in. Paint us a picture. What was the U.S. like in, say, early 1933?
Oh, it's hard to overstate how bad things were. You're talking about the absolute rock bottom of the Great Depression. The economy was just imploding.
Unemployment.
Through the roof,
Yeah.
Businesses failing everywhere, and critically for this story, the banks. The whole banking system was teetering on the edge of complete collapse. Bank runs were happening constantly.
Wait, people panicking, trying to pull their money out before their bank went under?
Exactly. And in that kind of fear-driven environment, people weren't just losing faith in the banks. They were losing faith in the dollar itself.
Because the dollar was still tied to gold back then, right? The gold standard?
Precisely. So if you lost faith in the paper dollar, what did you want? You wanted the actual gold it represented. People, businesses, even foreign governments started demanding physical gold in exchange for their dollars or their bank deposits.
So gold was flowing out of the banks, out of the Federal Reserve System.
Massively. A huge drain of gold. And this created a critical problem for the Federal Reserve itself because of the rules it operated under back then.
The Federal Reserve Act, what were those rules again?
The key one was that the Fed had to hold gold reserves equal to at least 40% of the value of the Federal Reserve notes, the paper money it had issued.
40% backing.
Yep. And even before the worst of the Depression hit, like in the late 1920s, the Fed was already kind of bumping up against its limit. They didn't have a huge amount of excess gold relative to the currency out there.
So when people started pulling gold out in massive amounts in 33,
it directly threatened the Fed's ability to legally back the currency. Their gold reserves were shrinking fast, pushing them closer and closer to that 40% minimum requirement.
Okay, so the Fed's in a bind. Normally, if a central bank on a gold standard is losing gold, what does it do?
Standard playbook. You tighten things up. You raise interest rates, maybe reduce the amount of money circulating, basically make your currency more attractive to hold, make it harder to get, so people stop exchanging it for gold.
But raising interest rates in 1933
would have been absolute poison. You're in the middle of a massive deflationary spiral. The economy's already collapsing. Raising rates would just pour gasoline on the fire, make the depression even worse.
So they were trapped. The gold standard mechanism that was supposed to provide stability was now forcing them toward actions that would destroy the economy.
Pretty much. They were paralyzed by the system itself in the face of this extreme emergency.
And this is where Franklin D. Roosevelt comes in, newly elected president.
Brand new president, yeah. And he acted fast. I mean, really fast. One of his very first actions, just days after his inauguration, in March 1933.
The bank holiday.
Exactly, March 6th. He declared a nationwide bank holiday. Which sounds nice, but it meant literally shutting down every single bank in the country for several days.
Just stop everything. Stop the runs, stop the withdrawals.
Stop the bleeding, give everyone, including the government, a moment to figure out what to do next. It was a radical step, but necessary to prevent total financial meltdown.
And then Congress acted quickly, too.
Unbelievably quickly. The Emergency Banking Relief Act passed on March 9th. Get this. It sailed through Congress, House and Senate almost unanimously. That tells you how serious the crisis felt to everyone.
Wow. And what did that act do? How did it relate to gold?
Crucially, it amended an old law, the Trading with the Enemy Act of 1917. Now, that sounds like it's for wartime, right?
Yeah, the name implies.
Right. But the 1917 Act gave the president really broad powers over transactions and property during wartime. The 1933 amendment basically said the president could use those powers during any national emergency declared by him, not just war. And it specifically gave the president the authority to regulate or prohibit the hoarding of gold or silver.
Oh, okay. So that's the legal hook. The Emergency Banking Act gave FDR the power to go after gold hoarding, citing the national economic emergency.
That's it. And, our sources mention that the bank holiday, plus this swift action by Congress, actually did help calm things down a tiny bit. Some money started trickling back into the banks when they reopened.
Bought some breathing room.
Exactly. But the underlying problem with the gold constraint on the Fed remained. So with this new legal authority in hand, the stage was set for the executive order on gold.
And the main reason, the rationale behind it.
It was really about monetary policy. They needed to break the golden handcuffs, so to speak, get the gold out of private hands, centralize it with the government, so it wasn't limiting the Fed's ability to act.
To free up the Fed from that 40% backing rule.
Right. If the government held all the gold, the Fed could then increase the money supply, pump liquidity into the economy, fight that awful deflation, and just try to get things moving again.
So the argument was less about grabbing wealth and more about fixing a broken monetary mechanism during an emergency.
That was certainly the government's justification, and it's how many economists and historians see it. A drastic measure, yes, but aimed at regaining control over monetary policy to fight the Depression.
Okay, that context is absolutely crucial. So now let's get into the specifics of Executive Order 6102 itself, signed April 5th, 1933. What did it actually say?
The core of it was the prohibition. It forbade the hoarding, that was the specific word used, of gold coin, gold bullion, and gold certificates within the continental U.S.
But not all gold, right? There was that threshold you mentioned earlier.
Exactly, and this is super important for understanding what really happened. The ban applied only to amounts over $100 in value.
And $100 back then, with gold at $20.67 an ounce.
It was about 5 troy ounces. So if you had, say, 3 ounces of gold coins, you were fine. If you had 10 ounces, you were technically hoarding the excess over 5 ounces.
And if you did have more than that, what did the order require?
You had a deadline. By May 1st, 1933, so less than a month, you had to deliver any gold coin, bullion, or certificates you held above that $100 limit to a Federal Reserve Bank or any bank that was part of the Fed system.
Deliver it. And this is the forced exchange part, not pure confiscation.
Yes, absolutely, a critical distinction. When you turned in your excess gold, you received payment in dollars. The government paid the official price, $20.67 per troy ounce.
So you got cash, but you didn't get to keep the gold itself above that small limit.
Correct. You were forced to swap your gold for paper money at the fixed rate. It wasn't like they just took it and gave you nothing.
But if you didn't comply, if you decided to keep your gold hidden,
the penalties were stiff. The order invoked the authority of that Emergency Banking Act, which drew on the Trading with the Enemy Act. Violations could mean a fine up to $10,000, which was a huge sum then, or up to 10 years in prison, or potentially both.
$10,000 in 1933. Wow. That's serious.
They weren't messing around. It showed they intended to enforce it.
So hoarding really meant holding gold as like a monetary asset outside the banking system beyond that small personal amount.
That's the heart of it. They wanted to stop people from using gold as an alternative money, keeping it out of circulation where it couldn't support the monetary base. They wanted it consolidated.
Were there other exemptions? What about gold used for, say, fillings or jewelry
or
collector coins?
Yes, definitely. And this really pushes back against the idea it was a total grab of all gold. Besides the $100 limit, there were clear exemptions.
Like what?
Gold needed for legitimate and customary use in industry, professions, or the arts. That was explicitly exempt.
So dentists using gold for fillings.
Yep. Jewelers making rings, artists using gold leaf, scientists using it in equipment. They could apply to hold reasonable amounts necessary for their work.
And you found an example of that.
Yeah, the Columbus Dental Manufacturing Company. They applied and got approval from the Fed to receive $10,000 worth of gold bars. That's almost 500 ounces. Specifically because they needed it for making dental products. So the industrial use exemption was real.
What about coin collectors? Someone with old gold coins.
Also an exemption, but with a condition. Gold coins held in collections were exempt if they were considered rare or unusual. The focus was meant to be on their numismatic value, their value as collectibles because of rarity or history, not just their raw gold content.
So trying to separate monetary gold from collectible gold, a tricky line maybe.
Potentially, yeah. But the intent was clear. Target the gold being held essentially as money, not necessarily historical artifacts.
And what about people whose business was gold? Miners, refiners?
They were also allowed to hold reasonable amounts needed for their normal business operations. The goal wasn't to shut down the gold industry, just to stop the private hoarding of monetary gold.
Okay, so let's recap EO 6102. It targeted monetary gold coins, bullion, certificates held above about 5 ounces. It required people to exchange that excess for dollars at the fixed rate by a deadline. But it exempted small amounts, industrial professional uses, and rare coins.
That's a much more accurate picture than just gold confiscation. It was a forced, compensated exchange aimed squarely at monetary gold held in significant private hoards.
But that wasn't the end of the gold story for the 1930s, was it? There was more legislation.
No, EO 6102 was just the first big step. The next major piece was the Gold Reserve Act, passed in January 1934.
And this one made some even bigger changes.
Oh, yeah. This act really solidified the government's control over gold and fundamentally altered the U.S. monetary system.
This is where they changed the price of gold, right?
Effectively, yes. The act gave the president the authority to revalue the dollar against gold. The old price had been $20.67 per ounce for nearly a century. Roosevelt promptly used this authority to set the new official price at 35 cents per ounce.
So gold went up in price.
Well, technically the dollar was devalued. Each dollar now bought you less gold. 1 ounce of gold was now worth $35 instead of $20.67. Same amount of gold, just took more dollars to equal it.
Why do that? What was the point of devaluing the dollar?
It massively increased the value in dollar terms of the gold the government now held. Remember all that gold turned in under EO 6102? Plus the Fed's existing reserves. By changing the price from $20.67 to $35, the government's gold stash could now legally back a much larger amount of paper currency.
So that's how they really broke the Fed's constraint. Devalue the dollar and suddenly your gold reserves are worth more on paper, allowing you to print more money.
Exactly. It gave the Fed the headroom it needed to expand the money supply and combat deflation, which was the overriding goal. All international gold transactions by the U.S. Treasury would now happen at this new $35 price.
And what happened to the physical gold itself? Where did it end up?
The Gold Reserve Act ordered all gold held by the Federal Reserve banks to be transferred to the ownership of the U.S. Treasury. Title literally passed to the Treasury. Fort Knox became the famous symbol of this centralized government gold hoard.
So the Fed didn't even hold the gold anymore?
Nope. The Treasury held gold. The Fed essentially became a domestic fiat currency manager, even though the dollar still had an international gold linkage at $35 an ounce for foreign central banks.
And for regular U.S. citizens, could they still exchange their paper dollars for gold coin after this?
Absolutely not. The Gold Reserve Act explicitly prohibited paying out gold coin or bullion in exchange for any currency or government obligations domestically. The internal convertibility of the dollar into gold was completely severed for individuals. Your paper dollar was just paper.
Wow. And didn't this revaluation create a sort of paper profit for the government?
It sure did. When the Treasury's gold went from being valued at $20.67 an ounce to $35 an ounce overnight, that created an instant profit on the books of about $2.8 billion.
$2.8 billion in 1934 dollars. What did they do with that windfall?
That money was used to set up something called the Exchange Stabilization Fund, or ESF. It's actually still around today. The ESF was designed to be used by the Treasury to intervene in foreign exchange markets to stabilize the dollar's value internationally.
Okay, so control the gold, devalue the dollar, centralize the gold in the Treasury and domestic convertibility, and create a fund to manage the dollar's exchange rate. That's a lot of changes.
It was a complete overhaul of the U.S. monetary system in less than a year.
But there was another controversial piece, wasn't there? Something about contracts.
Yes, the gold clauses. This caused a huge legal fight. See, many contracts back then, including private loans, corporate bonds, and even some U.S. government bonds like the Liberty bonds from World War I, had clauses promising payment in gold coin of the present standard of weight and fineness.
Meaning payment in actual gold or the equivalent value based on that $20.67 per ounce standard. It was a way to protect lenders against potential inflation or devaluation.
Exactly. It was contractual protection. But in June 1933, Congress passed a joint resolution, and the Gold Reserve Act later reinforced it. That basically said all these gold clauses were now against public policy and unenforceable.
So the government just unilaterally canceled those contract terms.
Pretty much. It declared that any debt, public or private, regardless of any gold clause, could be paid off simply dollar for dollar in current paper money, which was now worth less in terms of gold.
So if I lend someone $1,000 expecting payment in gold coin or its equivalent, and the dollar got devalued, they could now just pay me back with $1,000 in the cheaper paper dollars.
That's what the law said. And if you held a Liberty bond from the government that promised payment in gold, tough luck. You got paid in paper dollars too.
That sounds like a direct breach of contract, especially by the government itself on its own bonds. People must have sued over this.
Oh, absolutely. It went straight to the Supreme Court. The key cases, consolidated as the gold clause cases, were decided in early 1935. One famous one was Perry v. United States, involving a Liberty bond holder.
And the outcome, did the court strike down the government's actions?
Nope. The Supreme Court, in a series of, frankly, quite complex and somewhat contorted rulings, ultimately upheld the government.
How did they justify canceling the gold clauses, especially on government debt?
In the Perry case regarding the Liberty bond, the court actually agreed that Congress didn't have the authority to repudiate the government's own gold promise. It was a breach. However, the court then said the bondholder couldn't show any actual monetary damages.
How could they not show damages if the dollar was devalued?
The court argued that because internal gold ownership and circulation were now illegal, the bondholder couldn't have legally obtained or used the gold anyway. And, crucially, they argued that at the moment the bond was due, a paper dollar still had the same domestic purchasing power as a theoretical gold dollar would have had if it existed. So, no harm, no foul, essentially. It was a very fine legal distinction that allowed them to say the government breached its contract but didn't owe any extra money.
Wow, that feels like legal gymnastics.
Many thought so at the time. In other cases involving private contracts, Nortz v. United States was one, the court more broadly upheld Congress's power to regulate the monetary system, saying private contracts couldn't override that power. Nortz also cemented that gold certificates were now just like any other paper currency, not redeemable for gold.
Was the court unanimous?
No, not at all. There were fiery dissents, especially from the four conservative justices, the so-called Four Horsemen, who basically accused the majority of shredding the Constitution, property rights, and the sanctity of contracts. Justice McReynolds read his dissent aloud, famously saying, "This is Nero at his worst. The Constitution is gone."
Strong words, but the majority ruled and the government's actions stood.
They did. The court ultimately prioritized the government's power to manage the economy during an unprecedented crisis over strict adherence to contract clauses.
Okay, so the laws were in place, the Supreme Court gave its blessing. What about enforcement on the ground? Did they really go after people hiding gold after EO 6102?
It wasn't like G-men were kicking down doors searching for hidden coins in every helm. That's largely a myth. Enforcement seems to have been more targeted.
Targeted how?
Primarily focusing on banks complying, tracking large withdrawals or transactions that look suspicious after the order, and going after individuals or businesses who were clearly trying to circumvent the law or operate a black market in monetary gold.
So actual prosecutions happened. People went to jail.
Yes, there were prosecutions. We found records of quite a few cases brought under the executive orders and the Gold Reserve Act. It wasn't just an idle threat.
Any specific examples stand out?
Well, there's the case of Frederick Barber Campbell. He was a lawyer in New York, apparently quite wealthy. He had over 5,000 ounces of gold. That's a lot deposited at Chase Bank.
Okay.
After EO 6102, Chase refused to let him withdraw it. Campbell actually sued Chase to get his gold back. The government then turned around and indicted Campbell for failing to surrender the gold as required by the order.
Bold move by Campbell. How did that end?
It got complicated legally. A federal judge initially threw out the charge against Campbell based on a technicality. Apparently, the first version of the order wasn't properly countersigned by the Secretary of the Treasury. So the government quickly amended the order to fix that. Campbell's criminal prosecution ultimately failed because of that initial procedural issue. But, and this is key, the government's right to seize the gold itself was upheld, and his gold was eventually confiscated anyway.
So he lost the gold even if he beat the rap, so to speak.
Exactly. The government got the gold. There was another case, the Barabans, a father and son team of refiners. Their license got revoked, but they kept operating illegally. Federal agents raided them and found not just scrap jewelry, but a hidden box with thousands of dollars in gold coins. They were charged with conspiracy.
So enforcement focused on larger amounts, illegal operations, attempts to defy the system.
That seems to be the pattern. It wasn't a mass roundup of smallholders. Also, remember all the bank failures. Safe deposit boxes in failed banks often ended up in Treasury custody. If they were unclaimed, any gold inside would just passively become government property.
Right. Okay. This leads to a really interesting question that pops up all the time, especially when you see this discussed online, like on Reddit threads. Given all this, the forced exchange, the penalties, the lawsuits, why wasn't there more public outrage? Why no mass protests or even conflict? Gold confiscation sounds inherently inflammatory.
It's a great question, and the answer really lies in that context we talked about earlier. You absolutely have to put yourself back in 1933. People were desperate.
Survival mode.
Totally. The immediate, life-altering crisis wasn't about owning gold for most people. It was about finding a job, getting food, wondering if the bank holding their life savings would ever reopen. The banking collapse was terrifying and affected almost everyone directly.
So the government stepping in, even drastically, might have felt necessary.
For many, yes. Remember the bank holiday? It created this sense of national emergency. FDR was seen as taking decisive action. The Emergency Banking Act, which authorized the gold measures, flew through Congress with near unanimous support. That reflects a public mood desperate for solutions, willing to grant the president extraordinary power.
And the gold order was just one part of the much larger New Deal, right?
Exactly. The New Deal was this whirlwind of government programs, relief, jobs, farm aid, financial reforms. It was a massive intervention and hugely popular initially because people felt something was finally being done. The gold policy was presented as a necessary technical step to make all the other recovery efforts possible by fixing the money system.
And crucially, who did EO 6102 actually affect most directly?
That's maybe the most important factor. It wasn't the average person. Most Americans in 1933 simply didn't have large stashes of gold coins or bullion. They might own some jewelry, maybe a few keepsake coins, but those were generally exempt anyway.
So the order mainly hit banks, financial institutions, and wealthier individuals or businesses holding actual monetary gold above that 5-ounce limit.
Precisely. The vast majority of the nation's monetary gold was already in the banking system anyway, backing the currency. The order was about consolidating that gold and pulling in the larger private hoards, not about raiding grandma's jewelry box.
So if you combine the extreme economic fear, the sense of national emergency, the popularity of FDR and the New Deal, the fact that the action was legally authorized and upheld by the courts, and the reality that it didn't directly impact most people's personal possessions,
then the lack of widespread revolt becomes much more understandable. It wasn't seen by the majority as exactly. The Fed doesn't need to collect private gold to manage the money supply. That specific reason, the core rationale from 1933, just doesn't exist in our current fiat system.
So the trigger's gone, the mechanism's irrelevant.
Right. However, the underlying principle, that's maybe the enduring and slightly unsettling lesson.
Which is?
The principle that in a time of perceived extreme national crisis, the government can and has taken extraordinary measures regarding private assets. Measures authorized by law, upheld by courts, justified by the need for economic stability. If certain private assets are seen as hindering or threatening the government's ability to manage a crisis, history shows action is possible.
So it's less about gold specifically and more about the precedent for government intervention in private property during emergencies.
I think that's the key takeaway. And some analysts, like in that JNS source we looked at, point out that while the context is different, some broad macroeconomic conditions today aren't entirely dissimilar to the 1930s.
What kind of similarities?
Things like periods of very low, near-zero interest rates, huge government spending, and fiscal stimulus, maybe analogous in scale, if not form, to the New Deal central banks doing massive quantitative easing, expanding their balance sheets.
Which is sort of like the Fed's balance sheet expanding when it took in all that gold back then.
In a way, yeah. Plus, you see rising populism, debates about wealth inequality, echoes of that earlier era, even if the specific crises like the 2008 financial crisis or the COVID pandemic were very different from a gold standard collapse.
But huge differences too, obviously.
Oh, absolutely. No gold standard constraint, a much more globalized financial system, different types of assets, different market structures. You can't draw a straight line.
Okay, so the 1930s gold crisis was unique. Which brings us back to gold today. If it's not monetary base, why do people still value it? Why is it seen as a hedge, maybe even against the kind of government stimulus policies we just mentioned?
Well, gold still holds a certain allure. That CEPI analysis dug into this. Its history as money for thousands of years gives it this psychological weight, right? Like an ultimate store of value.
Plus, it's tangible, portable, recognized globally.
Exactly. It's liquid, trades everywhere. It isn't tied to one country's economy or government decisions in the same way a stock or bond is. So people see it as a potential safe haven, maybe a hedge against inflation, though the evidence on that is mixed, or just general chaos.
The theory being, if stocks or bonds or currencies are tanking, maybe gold will hold up.
That's the hope. The CEPI researchers look specifically at how gold behaves relative to stocks, especially during market stress.
And what did they find? Does it work as a safe haven?
Their findings were, well, nuanced. During general recessions, gold tended to have a low, sometimes near zero correlation with stocks. They called this a weak safe haven, meaning it might not go up a lot when stocks fall, but importantly, it doesn't necessarily fall with them. That makes it useful for diversification.
So it helps balance a portfolio because it marches to its own beat, somewhat, but not a guaranteed lifeboat.
Right. Now, they did find some evidence for what they called a strong safe haven behavior, specifically during sharp stock market declines, actual bear markets. In those situations, gold sometimes showed a negative correlation, meaning it tended to go up when stocks were plunging.
Ah, okay. That's more like what people hope for.
Yes, but they noted this wasn't consistent across all crises or all countries in their study period, which ran from the late 70s to 2009. So it can act as a strong safe haven sometimes, but it's not a sure thing every single time the market tanks.
And long term, how does it stack up?
Over the very long run, they found gold does seem to act as a hedge against stocks, suggesting that inverse relationship holds over decades. Interestingly, they also found that during crises, the market seemed to push gold back towards this long-run relationship faster.
But it's not a risk-free investment itself, right?
Yeah, definitely not. The CEPI paper really stresses this. Gold prices are volatile. They pointed out that over their long study period, stocks massively outperformed gold futures in total return. And gold futures can have technical costs, like negative roll yield, that eat into returns over time.
So useful for diversification, sometimes acts like a safe haven, but still risky and not guaranteed to protect you in every storm.
That sums it up pretty well. It's a unique asset, but not a magic bullet.
Which brings us right back to the core question. Could something like EO 6102 happen again today? Not necessarily gold, but that kind of government action on assets.
Okay, so based on everything we've discussed, a literal replay targeting physical gold to back the currency? Almost certainly not. The conditions just aren't there. The dollar's fiat. The Fed doesn't operate that way.
They don't need your gold for monetary policy.
Right. But again, the principle, the historical precedent, that's what lingers. The idea that in a truly severe national economic emergency, the government could potentially target some class of private assets if they believe those assets are obstructing vital policy or threatening stability.
And that action could be backed by emergency laws passed by Congress and upheld by the courts, just like in the 1930s?
That's the potential pathway demonstrated by history. So the relevant question today isn't really, will they take gold again? It's more like, in some future, maybe unimaginable crisis, could another asset, maybe something digital, maybe a commodity, maybe something else, entirely be seen as the modern equivalent of that hoarded gold from 1933?
Something seen as facilitating capital flight, or undermining monetary control, or operating outside the regulated system in a way that becomes a systemic threat during a crisis?
Exactly. Could large private holdings of cryptocurrencies, if they became truly systemic, be targeted? Could certain essential commodities face restrictions? Could there be controls on moving large sums into foreign currency if there was a panic out of the dollar? We don't know, obviously.
But the 1933 event forces you to ask those kinds of questions.
It does. And those lessons from the JNA source seem relevant again. Government crisis interventions can be extreme, even if temporary. They can have big, unpredictable consequences for asset values, and policy changes often happen suddenly, right when things are most fragile. The risk isn't a specific prediction, but the awareness that under extreme duress, governments might take actions that seem unthinkable in normal times.
So the real lesson isn't about gold hoarding, but about the potential scope of government power over private assets when faced with what it perceives as an existential economic threat.
The historical marker. It shows us where the boundary of government power was pushed during one of the nation's worst crises, a boundary set by Congress and affirmed by the Supreme Court in the name of national stability.
Well, this deep dive has definitely peeled back the layers on EO 6102. It wasn't a simple grab of everyone's gold. It was much more specific. A forced, compensated exchange of monetary gold above a threshold, targeting large holders and institutions, driven by the unique crisis of the gold standard collapsing during the Depression. With exemptions, legal backing, complex.
And we see gold today plays a totally different role. It's a financial asset, offers diversification, maybe some safe haven property sometimes, but it's risky. And it's certainly not the anchor of the monetary system anymore.
So, to answer the big question, a literal repeat of 1933, highly unlikely, but the precedent. The possibility of major government intervention in some form of private asset ownership during a future severe crisis. History suggests that remains on the table.
It forces a broader way of thinking about asset safety and what risk really means, including political or policy risk in extreme scenarios. What assets might be viewed differently by authorities during a panic.
Which leaves us with a final thought for you, the listener. In today's world, with huge government debts, massive central bank interventions, how do you balance the appeal of assets seen as outside the system, maybe gold, maybe crypto, maybe something else, against this historical example of government stepping in during a crisis? What assets, if any, are truly beyond the reach of state power when everything hits the fan?